Warm welcome to the second day of the online comprehensive course on valuation and valuation standards, organized by the Valuation Standard Boards of ICI for the esteemed members of the Institute of Chartered Accountants of Nepal. Today, we are honored to have with us a distinguished speaker, CA Chandra Sahani ji, founding partner and head of Valuation and Deals at Transit Corporate Advisors. With over 18 years of experience in business valuation and transaction advisory, Mr. Sahani is a fellow member of ICI, ICSI, and a registered valuer IBVI. Our expert speaker will delve into the financial reporting basics, covering essential topics such as basics of fair value, highest and best use, and disclosure in financial statements. Mr. Sahani's extensive expertise includes performing 2,000 plus valuations and 200 plus transactions across 30 industries. He has served on the central government MCA committee under Companies Registered Valuers and Valuation Rules 2017 and is currently a member, special invitee of the ICI Valuation Standard Boards. He is also the lead author of the two editions of the valuation book titled Business Valuation in India Beyond the Numbers. His international exposure addressing conferences globally showcases his commitment to excellence in valuation and transaction matters. We are privileged to have him guide us through the intricacies of today's topics. So please join me in extending a warm welcome to Mr. Chandra Sahani as he shares his insights and knowledge. So welcome, sir.
Thank you, Indrajit. And I'll just share my presentation. So please confirm that you can see the presentation.
Yes, sir. It is visible.
You can see. Okay.
Yes.
So first of all, thank you for inviting me to the event. And coming to the topic, what I understand is that the Institute of Chartered Accountants of India has specifically tailor-made this program for the members of the Institute of Chartered Accountants of Nepal. So basically one fellow professional, assisting the another professional body. The topic assigned to me today is financial reporting basics. So this is how the presentation will flow like that. If we talk of financial reporting, then basically we have to understand the Indian accounting standards. And Indian accounting standards are made in line with the global accounting standards, which is, international IFRS. So we will give an introduction of the Indian accounting standards. We will take you through the basics of fair value. What are the techniques of fair value? What is the specific hierarchy of fair value to be followed? What are the methodologies prescribed under the Ind AS 113, which is a fair value standard? Two specific valuation approach, just the broad context. I will cover the discounted cash flow valuation and the relative valuations. And going forward, I understand that there will be more detailing on these two particular valuation approaches, because when we typically derive fair value, then the most prominent income approach is discounted cash flow approach, and the most prominent market approach is relative valuation, which is comparable companies trading multiple or comparable companies transaction multiple. There are different valuation methodologies and there are different impacts. So I'll explain the methodologies and the value impact. What about the disclosures which are required under the Ind AS? We will cover that. And then at last, I will just close the session with the recommended valuation process. What is the minimum performance framework? Because it's very important to understand that though this program is being conducted by the Valuation Standards Board of the Institute of Chartered Accountants of India, but what happens that valuation standards lay down the principles. Valuation standards does not tell us that how much and to what extent we should do a due diligence, a detailing, extraction of data. And it has been observed that not only in India, but globally, there has been challenges in, despite valuation standards, the different valuers are adopting different valuation considerations, because of which the value reconciliations is not happening. The same problem is there with Indian IBBI as well. The same problem is there with US Securities and Exchange Commission of US. So, if we look at the minimum performance framework, it is important to understand that to what extent and how much, the problem of how much which is not being addressed by the valuation standards, that can be addressed by minimum performance framework, which actually exists in US as we speak. So the first point is that right now in India, if you are a public listed company, or if your particular financial position, let's say net worth, or exceeds a threshold limit, then you have to follow mandatorily the IND AS. And when we say IND AS is basically an Indianized version of IFRS. Now, IFRS are the international financial reporting standards which are adopted across the world. More than 100 countries adopt IFRS. So the idea was that instead of creating a new standard, India also adopted IFRS, but modified it to certain extent to for the Indian, for adopting it to the Indian conditions. So for us, we can say in simple terms that Ind AS and IFRS are converged and almost same. The idea is that if all the countries follow one particular set of standards, then there is improved comparability, there is transparency, there is qualitativeness of financial statements, and the financial statements become globally acceptable and reliable. Because if a person is sitting in UK and he knows that my this Indian company has prepared the financial statements in line with IFRS, the confidence increases. As we speak, US follows a different set of standards, which is US GAAP. But again, most of the standards, principle based standards, are not that different, like I just mentioned. So, what has happened actually is that when the Ind AS came into play, in India, it came into play in 2016, and gradually it got extended to a larger number of companies. To begin with, it started with like 2015, 16. So what has happened is that historically, if you look into the, like, you have the last session, I think, was on basics of finance. If you look into a balance sheet, then typically balance sheet reflects the all the assets and liabilities on a historical cost approach. The problem is that if everything is on historical cost, then it is difficult to assess what is the fair value. And that's why there is a requirement of valuation. But since the time the Ind AS has emerged, what has happened is that most of the assets and liabilities are now either to be valued and reported, or else disclosed in the financial statements. So the what has happened, that suppose a company A has invested in company B. Now company B, what is the value? They invested at a face value. Let's say the value is Indian rupees 100 rupees. So the book value is of 100 rupees. The value may be of 2000 rupees, right? So it is very difficult to understand, and that is why all the investments in financial instruments are required to be fair valued now. The only exception that they have given is that if you are a subsidiary company or you are an associate company, then you have an option of adopting the cost approach. Similarly, if you have invested in a real estate, which is your fixed assets basically, then you have an option of adopting the cost approach. But other than that, if you have invested in a third party, if it's an investment property, if it's just a pure investment, that needs to be fair valued, and for the first time, if you talk that other than the valuation standards, which standard talks about the word fair value, the only standard is Ind AS 113, which is a dedicated standard on fair value. And alongside Ind AS 113, there are some other standards which talk about specific fair value in particular circumstances. Let us say that you are doing a merger or amalgamation. So business combination comes into play, and Ind AS 103 is a dedicated standard on business combination. Similarly, if you have to value intangible assets, then you have to look at Ind AS 38, property, plant and equipment, Ind AS 16, impairment of assets, Ind AS 36, share-based payments, which is also called as employee stock options, Ind AS 102, financial instrument, again, Ind AS 113 is read along with Ind AS 109, financial instrument, and investment property, Ind AS 40. So the purpose of this slide is to give you a sense that what all standards are relevant for valuing what all category of assets. So Ind AS 113 is a master standard, and other standards are you have to read alongside Ind AS 113. The other standards do not tell us too much about the valuation aspects, but they do give us some insight of the financial reporting, about the disclosures, about the presentation aspect. So the focus of this presentation would be restricted to Ind AS 113, because the idea is to understand fair value, which is clearly defined in Ind AS 113. And Ind AS 113 is actually in line with IFRS, like we said, and even the valuation standards, whether the Indian valuation standard IC of the Institute of Chartered Accountants of India or the international valuation standards issued by the IVSC. All the standards are based on fair value only. So you have to understand that the fair value is a basic concept and the valuation standards are built on fair value. So it's very important to understand Ind AS 113, which is actually a global equivalent of IFRS 13, which is widely prevalent around the world, and ASC 820, which is specifically applied in US GAAP, but the name and numbers are different, but the principles don't change broadly. So Ind AS 113 defines fair value, number one. It also gives the framework for measurement of fair value. And third, there are disclosures about fair value. So these three things which are important is that there is fair value, there is a framework for measurement of fair value, and there are disclosures about fair value. Let's take it one by one. Let's start with the definition of fair value. So fair value is defined under the standard as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants at the measurement date. So all these blue highlighted portion are important things. That first of all, it is a price that would be received to sell an asset. So the idea is you are not doing a transaction. It is a financial reporting. That means that transaction has happened. And now you have to value that a transaction which happened at an entry value, because entry value was known. You have already accounted for it. Now under the financial reporting, we are determining an exit valuation. That is why it's written that price would be received to sell an asset or paid to transfer a liability. So it's not an entry valuation, point number one, it's an exit valuation. It is presumed that it's an orderly transaction. There is a willing buyer, there is a willing seller, and the valuation is being done at a point of time between market participants. So few takeaways from this definition is that it's a market-based measurement, not an entity-specific measurement. So if you have made investment in a particular company, you might have some more insight on what, maybe you know the promoters, maybe they are the neighbors. So you know a lot more what compared to what a general market or larger market would be knowing. So what you know specifically is not relevant for determining. What is known in the market is what assumptions are to be considered for this particular valuation. Second point, that it is to be valued based on the observable inputs. So what does this mean? That again, market would not be knowing about something which is not known. So when we say it's a market-based measurement, market generally knows about the historical facts and about the recent disclosures. Market may not be knowing if something is going to be happening tomorrow. Market certainly does not know. So that is why when we determine fair value, the idea is to rely more on the observable. Observable means known inputs. So whatever is known or knowable as on the valuation date, known or knowable as on the valuation date. That is a basic premise of valuation under the fair value standard. Third, that again, it does not matter whether a company wants to sell something, a company wants to buy something, a company is privy to something. Whatever is known to the larger market is important, and whatever is known only to a particular person is not important in fair value. Why these things are important to be understood? Because when a valuation is being done, when a model is being built, you have to make sure that the model is aligned to this. A model is not, it is not a synergy valuation, that it cannot be valuation for a particular investor or for a particular person or a company. It has to be a fair value based on all the information which is known or knowable on the valuation date. Then a few more things is, I just mentioned that it represents the exit price, and for all financial reporting valuation it will be exit price, because when we generally invest, a company is investing, it's a fair valuation is being done, but that fair valuation is not for financial reporting purpose. When it is for financial reporting, it represents the exit price. Fair value measurement is not adjusted for transaction cost. So when you are buying and something, buying or selling, you are, because you have to understand that when you do the transaction, then there is a transaction cost. Here, transaction has already happened. So we have to value basis today, and we don't have to consider the transaction cost which the company might have incurred earlier. Again, there is a presumption of orderly transaction, and there is also a presumption of principal market or most advantageous market. So the idea is that what should be the maximum possible value considering all of these aspects. And particularly for non-financial assets, there is an additional concept of HABU, which is highest and best use. And what does this mean is that if you are valuing a non-financial asset, you are valuing a property, let's say you're valuing property, plant and equipment, which is not a financial assets, not equity shares or something. You have to value considering the highest and best use. So if there is a piece of land, and that piece of land can be used for residential purpose, for commercial purpose, for industrial purpose, we have to look at what is the highest and best use. It's not that currently it is being used for something. So whatever is the entitlement of that asset, the rights of that land is more valuable than the land itself, at times. And in addition to the test of Habu, so for your Habu should meet three more additional requirements as per Ind AS 113. That one, it should be physically possible to do. Second, it should be legally permissible to do. And third, it should be financially feasible to do. So if you are saying that I am having an agriculture land, and on this land I can run a commercial establishment as well, and it is very much possible, I will be paying for some change of land use. So it is physically possible, it is financially feasible. But what if it is not legally permissible? What if the restriction, because sometimes if you go into an industrial area, you buy land, then the particular asset can be used for that particular purpose only. So it's very important that three tests are met. One, physical test, second, legal test, and third, financial test. So if all the three tests are met, whatever is the highest and best use, particularly for non-financial assets, that is what is to be considered while deriving a fair value. So again, we mentioned that we have to maximize the use of observable input. That means that we have to minimize the use of unobservable input. So a lot of assumptions can be made, but we have to make sure that we should take the most minimum assumptions, and the valuation should not happen on a hypothetical basis. And again, when we say observable, the simple for an equity share, the observable input is that if a financial instrument is listed on a recognized stock exchange, and it is actively traded there, then whatever is the quoted market price, that is the best observable input, because everybody knows that there is a actively trading, and this is the particular price. The moment we say that it is not traded, then we go to second level, and then we go to third level. We will discuss on that in the subsequent slides. So this is how the standard says that there are three levels of hierarchies. The level one is very simple, that there is a quoted price, there is a ready market, active market, and we know that there is a price. So one can go, one can buy, one can sell. And there is a principal market. For quoted shares, it could be recognized stock exchanges. For commodities, there could be commodity markets. But the most direct and observable input is if there is a principal market actively traded and there is a price there, right? So that is the price you have level one. If a valuation comes to a valuer has to see whether it can fall within level one. If it can fall within level one, you don't need to go to level two and level three. So it's not that we have to arrive a fair market value or we have to apply DCF or relative valuation in all cases. Answer is no. If there is observable input, if there is a ready market, there is a clear price which is listed there, then level one is all we have to do and don't need to move on to the level two or level three. What if there is no ready market? So if there is no ready market, let's say that we have to value unlisted shares. A company A has invested in certain equity shares of company B, and company B is not traded. There is no market for that. So it's an unquoted shares. How do you value unquoted share? Typical valuation methodologies. Again, what the level 2 says, that there is a principal market, but quoted price is not available. So there are similar companies which are available on the stock exchanges, but my company, the subject company, is not listed. What does that mean is that I can compare the valuation of my company by comparing it, by benchmarking it vis-a-vis the valuation of the comparable or the peer companies. So level 2 basically is with what we say the comparable companies market multiples. So there is a quoted market, there is a ready market. My share is not listed. That does not mean that there is no market, but yes, because my share is not listed, so I need to compare my share with the market valuation multiples of the peer set. So level 2 is basically when my company is unlisted, but there are similar companies which are listed, so I can compare basically. That is level 2. What if there is no level 1 and level 2? The only option is we have to rely on unobservable inputs. And when we say unobservable inputs, this means that there is little market activity for the asset or liability as on the measurement date. So you have to now do certain assumptions, and based on the assumptions, the valuation has to be derived. So level 3 is the case wherein your stock is not listed, your stock comparables do not exist, and so basically you have to apply the level 3 approaches And one of the most prominent level 3 approach is a discounted cash flow method, which basically, if we do a general valuation, then all the valuations DCF method is considered. But so specifically for Ind AS, specifically for financial reporting valuations, the discounted cash flow is categorized in level 3: option pricing models, other models, all the models wherein there is too much of assumptions. Because the problem in DCF is that it's garbage in and garbage out. So you assume that your cash flows will increase, then the value will be more. You assume that the cash flows will decrease, the value will be less. So a lot of dependency is there on the achievability of the business model, and how and to what extent, under what all scenarios the projections have been made. So the way financial reporting valuation works is that it gives preference to the observable inputs, and it gives less preference to the unobservable inputs. So I'm just continuing. There could be some questions as well. Maybe you can, we can have later on, we can have 5-10 minutes discussion, or you can just send across on the message link, and then maybe I can take it up later on. I'm just proceeding. Thank you. So coming to the valuation approaches. Now, whether it is financial reporting valuation or it is any other valuation, there are only 3 approaches of valuation. The first approach is market approach. The second approach is cost approach, which is also called as asset approach. And the third approach is income approach. So world over, when we do valuation, whether of an asset, whether of a business, whether of a tangible asset, intangible asset, the approaches are same. The methodologies change, but the approaches are same. What do you mean by market approach? That if there's a listed price, like we just discussed, the level 1 or level 2, both are a part of market approach. So the price is readily available, or if the price is not readily available, there are peer companies, and the benchmarking can be done with peer companies. So when we do benchmarking, we use that, and the methodology comes as comparable companies valuation method. We are comparing our company vis-a-vis the listed peer companies. And that is why, in this particular slide is the snapshot of what is there in Ind AS 113. So I have tried to extract the information from Ind AS 113 so that, we understand that Ind AS 113 is actually talking about valuation. Ind AS 113 is actually giving us perspective of how we should do valuation, and it is helping us when we are doing applying models like discounted cash flow models, while comparable companies valuation models, because there is a guidance on what should be considered and what should not be considered. Second approach is cost approach, wherein basically the idea is that what is the replacement cost? If I have bought an asset 10 years back, and I have to value the asset today, then what would that asset cost if I rebuild that asset today? So I will first consider the replacement cost new. I will try to find that if I buy this or if I build this, then how much would this cost? But because my asset is an old asset, so I will apply depreciation on that. And basically, this methodology is called as depreciated replacement cost, DRC methodology, wherein we consider not the cash flows of the business. We don't consider the multiples of the comparable companies, but what we look at is what is the cost of reproduction, cost of replacing the asset in the present form. So you can't get a 10-year-old machine, but what you can buy a new machine today, and then you can depreciate it by 10 years or whatever is the usage of the existing asset, and that can give you the replacement cost post depreciation. So depreciated replacement cost. The most important and most widely approach is income approach, wherein we apply discounted cash flow valuation. We will consider that. And again, there are other methodologies like option pricing models. I think the subsequent session is on Black-Scholes model, option pricing model. So you will understand that. And then there could be, multi-period excess earning models, and there are more models. We are not going into the details of that. But in general, this slide is not there in Ind AS 113. But this slide, I generally explain that typically, if you look into all the green tick marks, so there is, asset approach, income approach, market approach, and other methods. And then asset approach, we do some replacement value method. Income approach, we apply discounted cash flow method. Market approach, we generally apply comparable companies market multiple method and comparable transaction multiples method. So difference between comparable companies market multiple is that the market multiple is benchmarking with listed companies. The transaction multiple is benchmarking with unlisted companies. So basically, the companies like wherein some private equity has taken place, some venture capital has taken place, those are comparable transactions. And from the comparable transactions, the value is compared. And then there are different methods like we just discussed. So let's come to the two methodologies briefly. So you understand when the session is taken up later on, you have a broad understanding of how these models work, and you can also ask relevant questions to the subsequent speakers. So what is discounted cash flow? Is that discounted cash flow expresses the present value of the business as a function of the future cash earning capacity. So whatever the business will earn over a period of time, that is forecasted, and then that is discounted today. Very simple. You have to create projections of the business, you have to derive the cash flows of the business, and you have to discount all the cash flows of the business on the valuation date. The value derived is called as enterprise value. Out of enterprise value, and when we derive enterprise value and when we say cash flows, so cash flow is not your profits. Cash flow is your profits after adjusting for your depreciation, which is non-cash item, after adjusting for your interest cost, because when we add your interest cost, we arrive at the value for the firm, after reducing the investable amount in working capital. There are businesses which are, working capital intensive. So whatever amount of blockage happens in working capital, non-cash working capital, that needs to be reduced. Whatever amount of capex investment is to be done, that amount is to be reduced. So it is net cash flows actually. Cash inflows minus cash outflows. Whatever are the net cash inflows, that is to be discounted. And we will cover that how the discounting rate is derived. That's it, because in discounted cash flow, the first fundamental aspect is how do you project the cash flows. Second is how do you discount the cash flows. And the third is that, how many number of years you should project. So generally in practice, we take 5-7 years of projections, but a business does not get over in 5-7 years. So after 5-7 years, there is a terminal value which is given, and that terminal value we also I'll touch that how that value is derived. But the value of a business is actually usually infinite unless and until you are valuing a project company. Let's say you are valuing a toll project, you are valuing a power plant. So there is a life of a project. So if you are doing a valuation which is having a particular life, then you have to consider the entire life. It can be 5 years, 10 years, 25 years, whatever it is. And after that, we don't apply perpetuity. However, if it is not a project company, it is a operating company, then operating company, we presume that it will be running infinitely. And what does that mean? That we do a cash flows for a particular number of years. And then after that, we put a value of the perpetuity, which is also called as terminal value. So once we do the discounted value of discrete period and the perpetuity, the value derived is enterprise value. From the enterprise value, we do certain adjustments of the debt, which is also called as borrowing, which is reduced, and the cash and cash equivalents are added, and the resultant value is equity value, which is the value attributable to the equity shareholders. So you have to understand that there is a difference between enterprise value and equity value. Enterprise value is the value of the firm. So when we say that there is discounted cash flow valuation or discounted cash flow valuation of firm, that means that we are doing the valuation for the enterprise. But when we say discounted cash flow to equity, that means that we are doing valuation for equity shareholder. So there are two ways again. We can do a discounted cash flow to firm, and then we can adjust for this borrowings and cash equivalent. The value is equity value. Another alternative methodology is that we can apply direct methodology, discounted cash flow to equity. In practice, I can tell you that we, in more than 90% of the cases, we apply discounted cash flow to firm, which is the valuation at an enterprise value. But sometimes the discounted cash flow to equity is also applied, mostly for BFSI sector. So when you have to value a banking company, or you have to value generally for BFSI sector, I would suggest that, comparable companies, market multiple, using the price to book value is uh, still better off than discounted cash flow to equity. But in case you have to value the BFSI sector like a bank or NBFC, you cannot apply discounted cash flow to firm. The only methodology after the price to book value methodology comes as discounted cash flow to equity. The challenge is that when you say you are valuing an NBFC, or you are valuing, I mean, what is the borrowing of an NBFC? The general concept is, we say that for an operating company, the borrowing is, the interest bearing debt. But just think of an NBFC. NBFC, what does NBFC do? It takes loans from banks and it lends, right? So the entire amount of money that it is, the interest and borrowing is in the nature of working capital for an NBFC. What does that mean? That the basic concept of segregation of working capital and debt does not exist in case of an NBFC. And that is why for financial companies, we avoid doing discounted cash flow to firm. We rely on more credible valuation methodologies, which is like price to book value method I said. But alternatively, discounted cash flow to equity can also be used. So in terms of the process, if you look at this, process is made by us, and I will also show you the process which is recommended under the Ind AS 113. So we need to understand the business model first. It's not that a company comes to you and gives certain projections and you do discounting and derive a value. It never works. You have to understand the business model. You have to identify the business cycles. Sometimes in some businesses, the cycles are up, sometimes the cycle are down. So whether at that point, because valuation is at a point of time, the point of time changes, valuation changes. So at the point of time, known or knowable as on the valuation date, go back and see what is known or knowable on the valuation date. Do look at the historical financial performance. 3 to 5 year historical financial performance must be seen. The present review of industry and regulatory trends should be done. The future growth plans should be understood from the company and management, and also of the competitors. If there are listed companies, we must look at what kind of growth estimates are being made by the listed companies. So the future growth plan should be understood. Then the business should be segregated into operating and non-operating. It's very important point, because when I say that we do a enterprise value, that is actually operating enterprise value. If a company has invested in a surplus asset, let's say that a company has an immovable property which is not being used for business operations, there won't be any cash flows, correct? It's a surplus asset. So what does this mean? That the cash flows, we have to make sure that there is no duplication. The cash flows, whatever cash flows are coming from certain assets, you can't value those assets because you have already considered the value of cash flows. But what if there are assets which are not generating any cash flows? Those are the non-operating assets, and the non-operating assets are to be separately added on the valuation date. So that is why you need to first identify that what are the non-operating or what are the surplus assets which are not generating any cash flows. So you can add them just like you do adjustment of debt and cash on the valuation date. You have to do a similar adjustment of surplus asset on the valuation date. Again, the reasonable projection should be there, considering the industry, considering the company, considering the changing regulations. Specifically, think of companies like fintech companies, think of companies like new age companies. All these companies you see in India every day, there is a new regulation of RBI, of tax, of SEBI, concerning about, let's say, gift city. Now the new concepts which are there, every new concept is evolving, it takes time, correct? So make sure that what kind of business it is it a stable business, mature business, or it is a growing business? So based on that, we have to do present value discounted at a weighted average cost of capital. And when we say that discounting is at weighted average cost of capital, we will take up that what is weighted average cost of capital. It will help you in understand. Typically, this is how the discounted cash flow looks like. Let's say we have done a projection for 5 years. The perpetuity still occupies a majority of value. It could be as much as 70 to 80% value. So make sure that perpetuity assumptions are taken right. The growth rate, the discount rate in perpetuity can be different, and it is very important. A slight change in these discount rate numbers, these growth rate numbers can be, changing the valuation a lot. Remember that generally, by and large, the perpetuity valuation is done using Gordon growth model. And Gordon growth model, how does that work? Again, you will be taught about it in detail, but at a broad level, that the last year cash flows, which is highlighted in orange here, that cash flow, let's say, is the last year cash flows of the discrete period. And considering that that is a stable, because when do you apply the Gordon growth model? You only apply that model when your business has stabilized. So if your business has not stabilized, you need to extend the projections. But if your business has stabilized, then what you need to do, that you need to apply the perpetuity at that point of time, and then perpetuity plus the normal cash flows. If you put that together, discount it to the present value, that is your discounted cash flow. Now let's connect to the Ind AS 113. How does Ind AS 113 tell us about how should we do projections and how should we estimate the discount rate? So all this particular slide is again extract of Ind AS 113. It says that discounted cash flow is an estimate of future cash flows for the assets and liabilities, which is correct. There are expectations about possible variations in the amount and timing of cash flows, representing uncertainty, which is also correct. We cannot identify that exact, what should be the exact timing and exact value. So it's all, relative. There can be different scenarios which can be made. Then third point is time value of money, represented by the rate on which risk-free monetary assets having maturity coinciding with the period of cash flow. So what does this say? That the first, it has said that what should be the cash flows, and the cash flows, we have to project the amount and we have to project the timing, and then we have to discount. And when we have to discount, we have to consider a few aspects like risk-free rate, like risk premium, and like a company specific risk premium. So if you look into the last three things, which is a risk free rate, risk premium, and a company specific risk premium, if you add all these three, risk free rate is, let's say, 10-year government of India discount rate, which is presently 7%. What is the risk premium? So risk premium is that because we are valuing equities, we are not valuing a fixed deposit. So let's say that, let's go back and look into the historical returns which have been given by, let's say, a Bombay Stock Exchange. And if you go back in the history of Bombay Stock Exchange, the average the return which has been given in the last 40 years, is about, let's say, 15%. The risk-free rate today is 7%. So the risk premium is the market rate, which is 15% minus the risk-free rate. 15 minus 7, which is 8%. So, and again, there is an element of beta here, because when we are valuing a company, there could be some companies which are high beta companies. There are some companies which could be low beta companies. So beta is basically that when my market moves up, then whether my share moves more or moves less. To give you an perspective, the FMCG industry and the pharma industry is considered to be low beta, but the banking industry is considered to be high beta. What does this mean? That if a share price, if the market moves up, then which industry will move more and which industry will move less. So considering all of these aspects, we derive a weighted average cost of capital, and which is a hybrid of the cost of debt and the weight of debt of the company or the industry, and the cost of equity and the weight of equity in the capital structure. So the capital structure is to be drawn, debt equity is to be drawn, and their particular cost is to be drawn. So this risk-free rate, risk premium, and company-specific risk premium, this derives the cost of equity. And the cost of debt is relatively simpler. We have taken debt. We know what is the cost of debt. So in general, the cost of debt is less than the cost of equity. The cost of debt is on the higher side because there is a risk involved. And depending upon what kind of debt equity is there, we can derive uh, the weighted average cost of capital. Again, there are certain guidance that the currency should be same. So the discount rate should, if the discount rate is in INR, then the cash flow should also be in INR, to make sure that there is no exchange rate risk. And like that, there are certain examples which are there. Some factors which maybe you can note and you can understand that at a discounted cash flow level, FCFE versus FCFF, we just discussed that. Second important point is that who prepares the projections. Very important, because sometimes you will do a valuation and a company will be giving you projections. So make sure that the projections are always prepared by the company, but it is the responsibility of the valuer to sanitize and make sure that he has understood the projections, and if he has raised the relevant questions with the management and he is satisfied with the projections. Because if you do not sanitize the projections, then there is no use of applying a discounted cash flow methodology. Management will, whenever management wants a particular value, management can prepare the cash flows accordingly. So it is the responsibility of the management to prepare the projections, but at the same time, it is the responsibility of the valuer to rely. And if as valuer, you have reasons to believe that these projections are not reasonable projections, it may be aggressive, it can be less or more. And if you have reasonable evidence, you should discuss with the company, and you can decide whether you can accept those projections, or maybe if not, whether you have a better alternative. Maybe if there is an observable input, why to go into the discounted cash flow, and why not benchmark the company vis-a-vis the comparable company. So again, now I hope I have been able to explain that how DCF is challenging because there are a lot of unobservable inputs. And when we look into market approach, and that is the reason in all the stock market people, they don't look at DCF. Most likely they look at P multiples, EV EBITDA multiples. They know it's simpler. They know they can compare. And if something is available today at X price, why will one pay 2x, 3x? Correct. If something is not available, you can still pay. So these are the different aspects of depreciation, taxation, debt equity, working capital, capex, pre-money, post-money. So when we look into cash flows, the left side issues are there, that these are all the issues which are there. And when we look into the discount rate, then on the right side issues are there. So these two are important aspects, which is the cash flows and the discount rates. Again, these two important aspects, if we understand, I think we can do this discounted cash flow valuation comfortably. Let's come to the second point, which is relative valuation. So relative valuation is, again, it's not the fundamental valuation, but it's a comparable valuation. So the value of an asset here is compared to the value already assessed by the market for similar or comparable assets. So a simple example, we have to value a particular NBFC. We have to value an NBFC which is unlisted. So the way to do it using relative valuation is to find similar NBFCs which operate in similar kind of financing. Let's say you can be doing a gold financing, then you have to find similar companies. You can be doing a consumer lending, you can be doing a mortgage-based financing. So find the exact, may not be exact, similar, I would say, similar kind of companies which have the similar risk and return characteristics. The idea is not to find and benchmark apple to apple. The idea is to find out that what is the risk and return characteristic of my company and what is the risk and return characteristic of the comparable companies. And if the risk and return characteristics, what could be risk and return characteristics? Just think of that. What are the EBITDA margins of my company? What is the past growth trend of my company? What is the debt equity ratio of my company? Whether the comparable companies which I am considering, whether the ratios match or not. So it has to be understood that if you are saying that some companies are comparable, then their growth rate, their margins, their debt equities should broadly aligned. And if they're broadly aligned, we say that they are comparable companies. And so we can take out all the valuation multiples, which could be a P multiple, a price to book value multiple, EV/EBITDA valuation multiple, even a price to sales multiple. All those multiples can be derived, and a median multiple can then be considered as a reasonable valuation multiple for relative valuation. Even the cases where we apply discounted cash flows, even in those cases, we give focus on the relative valuations, because if we just consider discounted cash flow, again, discounted cash flow could be very much opinionated. In a discounted cash flow, you know, I am a promoter, I could be very aggressive, and I can say my business can grow 7 times in 4 years. Practically, it may not happen, right? So relative valuation puts into that sanity, and relative valuation focuses on where do you stand today, and basis that, it does the valuation based on what is observable and known today. So the three-step process here is that first you have to identify that what are the comparable assets, what are the comparable companies, and what are their market valuations. Second point, you need to convert, because let's say that we say one company has a market cap of 2000 crores, second company has a market cap of 4000 crores, third company has a market cap of 5000 crores. How do you compare? Can you compare market cap and derive valuation? No. You have to convert the market values into standard values. What do you mean by standard values? You have to derive them into some kind of multiples. Like if that company, the comparable company, is doing a sales of 100 crores and it is getting a market capitalization of 500 crores, that means that the multiple of my sales, I am getting a 5 times multiple of my sales. So 5 times of sales is equal to my market cap. Similar multiples can be derived of profits. It could be net profits, it could be operating profits, it could be even on non-financial metrics like number of hotels. If there is a hotel, how many rooms I am having? If I am having 400 rooms and my market capitalization is 400, that means that each room is commanding a value of 1 crore rupees. So again, there has to be certain common metrics based on which my valuation can be compared. And Step one is identification of the right comparables. Step two is converting them into certain standardized multiples. And step three is comparison. This is how you will do a relative valuation. And typically, like I mentioned, four commonly adopted valuation multiples: your sales multiple, your book value multiple, your profit multiple, and your EBITDA multiple. Out of all four, I would strongly recommend use of EV/EBITDA multiple, because EV/EBITDA multiple is uh, the most closest to the cash flows, though not the cash flows, but closest to the cash flows. And the only industry wherein I would say avoid EV/EBITDA multiple is again the BFSI industry, wherein I just mentioned that if you are valuing a bank, an NBFC, an insurance company, maybe consider the price to book value method, which is more relevant than a EV/EBITDA method, because they are not generally looked by the cash flows. They are more importantly looked by the kind of book value multiples. The challenge here is that you have to understand that if you take 10 companies and 10 companies are comparable companies, then if you take an average of the multiples, then what will happen that I'll give you an example in case of an NBFC. If you look into, we were just discussing today that let's take an example of Bajaj Finance. Now, Bajaj Finance is getting a price to book of more than six to seven times, but the average price to book of other companies would be in the range of 2 to 3 times. So if you do an average, then it will take the smallest, it will take the largest, and it will take all in between. So it will get tilted, and maybe the not the right way to value. Instead of doing an average, what if we consider a median number? Median number is a mid period number. So median excludes the outlier. So one way to do it is that you can manually exclude the outliers. You can say that my sales is in this range, my profits is in this range. So I will not look at companies which are 5 times bigger or 10 times bigger or something like that. But that's a manual process. A better version is that despite doing that process, there would still be certain outliers. So when we do a median multiple, when we apply a median multiple, that removes the outliers. So again, there are certain multiples which will result in equity value, and there are certain multiples which will result in enterprise value. So if you do a PE multiple, if you do a book value multiple, if you do a market cap to sales multiple, the result is equity value. If you apply something like EBIT, something like EBITDA, something like EV by sales, the answer is enterprise value. So make sure that what is the kind of multiple you are applying, and make sure that if the multiple is resulting in enterprise value, then you have to adjust for debt and cash to arrive at the equity value. And again, there is a functions, assets, and risk analysis which is recommended to make sure that we don't find the wrong comparables. The functions are right, the nature of assets are right, the risk is right. So basis that, we can find comparables. Again, we have discussed these aspects, that how to adjust for non-operating assets. So non-operating assets, like I told you, in DCF, the non-operating assets are to be added separately. Once we derive the operating value, then we add the value of non-operating value, just like same. And we discussed on comparable trading and comparable transactions multiples, how are they different, and what is the suggested process for finalizing the peer companies. I would say the most challenging part, and do discuss this in the future sessions, that what happens that every person comes with a particular value, and there are different companies listed. Some companies get lower value, some companies get higher value. So you can just consider the relevant companies and say that this is my comparable company and get the value you want. Never recommended. The ideal process is to consider the entire industry set, to consider the range of companies, to consider the actively traded companies, to consider the companies which match with your business model, and then make sure that you apply median that is a correct methodology, because if tomorrow you do a valuation and you say that there are 4 comparables, what if I bring you 3 more comparables and you don't have answer to that? So make sure that when you consider the listed comparables or transaction comparables, you do not exclude any comparable. You consider all the comparables, and if you are excluding it, there should be a reasonable basis for that. And only if there is a reasonable basis and you document, you justify, you explain, then only you do that. So again, some methodologies result in equity valuation, and some result in enterprise valuation, we just discussed. At the same time, certain methodologies result in minority valuation, and certain methodologies result in controlling valuation. So I might be going fast, but the idea is to give you a broad perspective, because you are just taking up this session, and it's an early stage of this program, and this will help you in asking the relevant questions and understanding, how does, because if your foundation is strong, then you can do valuations properly, you can understand the financial reporting properly. So just to give you a synopsis, that if you do a discounted cash flow valuation, generally it's a controlling valuation. If you do a comparable company's transaction multiple, because for valuation of transaction multiples, what we are doing, we are considering the private equity transactions, the venture capital transactions. So there is an element of control there. However, if you are considering the traded multiples, then in that case, the on the stock exchanges, whatever the price is reflected, that is not a controlling valuation, that's a minority valuation. And if you are doing a book value approach, generally the asset approach is not applied in practice for valuation on a going concern basis. The reason being that even if you do an asset fair value, it cannot consider the intangible valuations, because intangibles are not reported as per the financial reporting standards. Only an intangible, which is an acquired intangible, can be reported. Self-generated intangibles cannot be reported. So if you started a business 100 years back, what is the value of that brand? What is the value of Tata brand today? Think like that. So the brand valuations do not get reflected on the financial reporting standard, even if we are saying fair value standard. But typically we have seen like brands like, Coca-Cola and Apple and Amazon. These have huge connect and huge value, which is not there, not reflected on the balance sheet. So that's why that uh, property, plant, and equipment has a limited value for a service industry, maybe a decent value for a manufacturing enterprise, but not that much of value for in the technology space or in the service space. So we are done with an hour, and I have 3-4 slides left. So maybe I'll first complete the session, and then maybe I'll try to complete in the next 5-7 minutes, and then let's see if there are questions. Otherwise, we can just discuss on some specifics. There are particular disclosure requirements that when you are doing a fair value measurement, you are doing the fair value measurement regularly, or you are doing a fair value measurement at a point of time. So disclosures are to be based upon whether the fair value measurement is recurring or non-recurring. So if you look into this table, then what this tells us, that if you have to do fair value at a reporting date, so you have to report on whether it's recurring or non-recurring, it does not change. The reason of fair value measurement, if it is a recurring fair value measurement, you don't need to specify the reason. But if it's non-recurring, if you are doing it for one time, you need to explain that. Fair value hierarchy is to be explained. When you have derived the fair value, whether you have considered level 1, level 2, level 3. And if you are changing, then why you are changing, that also needs to be explained. The valuation technique. So you have applied level 3, but level 3 is unobservable. So how have you done that? What is the particular methodology? Have you obtained an independent valuation report? what is the basis for that, and what is the justification. Again, level 3 disclosures are more, because in level 3 the valuation process is to be asked, the valuation policies is to be asked, and then again, level 3 is unobservable input. So you have to explain the approach, because if you look into the disclosure also, then the disclosures are like this, that if you are doing something based on observable inputs, then that is known. But the moment you have taken an unobservable input, you need to explain. You have to even explain the sensitivity analysis, that if your growth rate changes, what is the value impact? If your discount rate changes, what is the value impact? And Habu, like we discussed, that in case of non-financial asset, that if the highest and best use is different from the current use, then you have to explain that how that is done. And these are the total level of disclosure which you have to give. And the last slide, which I said that this is prepared by me personally, and this is the kind of minimum performance framework that I would recommend, that any valuer who is doing a valuation, you must do this kind of diligence. And once you do this diligence, then I am sure that any questions that come to your valuation, you can explain the questions, and you can justify. So first is that you should understand that what is the purpose of valuation and what is the valuation date. All the facts, all the information, all the analysis is to be done based on the purpose of valuation, based on the valuation date. Whether you are doing a valuation for a particular regulator, whether you are doing for financial reporting, whether you are doing to for a seller's perspective, for a buyer's perspective, for an investor's perspective, and on what date. Everything is centric towards purpose of valuation and valuation date. Based on these two aspects, you should ask the relevant information from the company. After analyzing the company's historical, it's not that you have to look at, let's say, that the purpose of valuation is business valuation. Management wants to understand what is the value of its business. Or if there is a financial reporting scenario, let's say that a company A had made investment in company B, and company B is into losses. So the auditors of company A might be saying that I do not get confidence of the carrying value. So you are still carrying at a book value, but I feel that the value might have diminished. So how do you value that at a particular? And generally, this impairment valuation or carrying value assessment, which is done in line with Ind AS 36, is done on a annual basis based on the balance sheet at the time of audits. So you have to understand that what have been your historical financials. You have to understand the key ratios. You have to understand the track record of the management. And then besides that, you have to look into the independent research also. So I have seen a number of valuation wherein, the valuers do the valuation based only on the information which is submitted to them. And the problem is that they fail to do due diligence. The problem is that they do not do independent assessment. See, today all the information is available in public domain. If you have to find credit rating of a company, you can just Google, you can find out the credit rating of a company. The credit rating sometimes can give very recent information which is not even available with the company. When I mean that not even available, that means that generally when we value an unlisted company, we say that a company prepares financial statements on an annual basis. But when you go for credit rating, it has been seen that the credit rating agency definitely asks for the financial performance. Like, we are sitting in December. So if a company goes to credit rating agency today, then credit rating agency definitely will look at the H1 financials, which means that April to September financials. What has been the performance? What is the debt position as on September? Now, all those numbers can be very different from the last audited numbers. Correct. So we have to analyze the historical financial performance. We have to analyze the key financial ratios. We have to look into that whatever the management has estimated in the past, whether that has happened or not. and we have to do an independent diligence. Without that independent diligence, no valuation is good. Because if you just look into the projections, look into the facts and figures provided by the management, and here also, most of the time the valuations are done in middle of the year. The valuations for financial reporting, the valuations mostly are there on the end of the financial year. So those can be based on the audited financials. But if you look into the other valuations, then they are generally performed in the middle of the year. And I have seen valuers relying only on the provisional balance sheets, not looking back into the audited balance sheet, and not reading the management estimates of the earlier years, the auditor observations of the earlier year, which is very important, because the provisional balance sheet is prone to manipulation. And as a valuer, as an accountant, we have to go by the principles of professional skepticism, and we have to make sure that whatever is being told to us, that is independently verified and the findings are documented. So once we have understood and got the comfort of the company, how the company has, what is the model of the company and how the company has achieved the financials, we have to look forward to the industry, because company cannot operate out of the industry. I mean, if we are valuing an Indian company, then we have to first look into that, at what growth Indian companies are growing. In fact, what is the GDP estimate of the country as a whole? Then in that particular country, what are the estimates, growth estimates of particular industries? What are the profit margins of particular industries? And whether the company estimates and the industry estimates are same or different. Unless and until the company is doing very, I mean, something which is very much based out of innovation. If my company has prepared something which does not exist, it could be one in a million. But by and large, the valuations would be that there would be comparable companies, and so the trend should be in line. So peer company is very important. And when we do, once we ascertain the peer companies, it simplifies the process, because we can benchmark the same peer companies for the valuations also, for the risk and return ratios also, for understanding the industry also, for understanding the valuation multiples also. So then we can compare the company vis-a-vis the industry. We can apply the valuation approaches, relevant valuation approaches, and then later on we can, again, when the operating valuation part is done, what we have to do is that we have to consider the non-operating assets, and we have to consider the surplus assets, debt, cash, and we have to discount it to derive at the concluded value and document the same. So I'm sure there would be few questions. So maybe Rahul, if we can, have a few discussions on question and answer. Can you allow the people to ask the relevant questions?
Sir, we haven't received any questions yet, and there was no as such Q&A session for this session.
No, but can we allow? I think we have some time right
Yeah, we
now.
have, but we haven't received any.
Is there, uh, can people ask the questions or not?
Yeah, people can ask the question if
Yeah, but
they want.
right now, can they ask over this call?
I
No,
think
no,
they
no, sir.
can.
Actually, they will ask from my end, and I will
Yeah,
forward it
so
to
I
you.
mean, I would request if anybody wants to discuss or raise any questions on the on any of the valuation aspects, not only restricted to this financial reporting, any of the aspect that comes to your mind, whether on the valuation standards, on valuation approaches, when feel free to send your question. Uh, the idea, just like this slide looks, valuation actually is kind of this only, that some people can look it as half full and some people can look it as half empty. So it's a glass which is, I don't know how you are looking at it, whether you are looking it half full of water or half without water. But the point is that when we framed the valuation standards, the Institute of Chartered Accountants of India, the idea was to standardize the valuations. And again, now,
I have one question received so far.
yeah, please.
What could be done if the industry standards are not available?
No, so
If in Nepal we do not have published industry data in most of the business sectors.
So, I mean, you look at, listed companies or industry leaders. I'm sure that you are still preparing annual reports. So the listed companies are definitely making certain assumptions, certain forecasts of how does it look like? How does the future look like? And I think, I mean, industry is something which is available. I'm not aware much about to what extent there are disclosure requirements in Nepal, but what I understand is that all the companies have to make assumptions, and I mean, it's not that difficult to derive the industry information. In fact, if you want to derive certain industry information, there are companies like in India, for example, there is this organization called as IBEF, which keeps on doing research. And there are other organizations as well, which government organizations and other organizations, which keep on doing assessment of the future growth of companies and future growth of business. So there would be capital markets, there would be industry leaders, which can, help us understand. But I'm sure there would be sources to, um, I mean, this question would be relevant had it been, 30, 40 years back, we would be talking. But today, with the, I mean, over the internet, it's just that whether you are trying to give that kind of time to that engagement or not. But you will get the answers. Yeah, so
Okay.
I was basically saying that valuation standards help us in standardizing the principles, what all approaches should be applied. Even if you look into India's 113, India's 113 has given us perspective. I mean, you should first follow the observable inputs, then you should follow the unobservable input. So the idea is that the standards can give us these kind of perspectives and these kind of guidances. And after that, it depends upon the ability of the valuer to understand that. And that is why that what we recommend, that besides the standards, there are a lot of training workshops. So before you become a valuer, you have to do certain kind of training. But even after that, there are regular trainings. Like this is a fantastic program to educate, our fellow professionals. So, I mean, these kind of things and CPRs and all, because not everybody is equally, one can have a degree, but experience is different. If, let's say, four of us are doing valuation, and I have been doing it for, let's say, 18, 20 years, and another person has been doing it for 3 years, the experience will be different. So in valuation, what matters is the judgment. I mean, data is available. And I have been doing valuation for so long, but I mean, the way other people look at it, I don't look at it like that, because the difference is the judgment. You should understand that how much valuation multiples this kind of industry can command. With experience, a lot can change, and that is why the minimum performance framework considers all those aspects. That yes, valuer has done enough diligence, the valuer has done enough detailing, the valuer has satisfied himself that yes, the numbers on which the valuation is being performed are reliable numbers. Because there are different approaches, nobody tells us which approach to use. That depends upon the facts of the case. So I mean, all of these things are important and relevant. And valuation date, like I said, is very important. The facts known or knowable on the valuation date is very important. Observable input principle is very important. And I think if we look into all these principles properly, then I'm sure that the valuation could be reasonable and justifiable. But do make sure that any valuation, for whatever purpose it is being done, it is done after understanding the historical basis of the company, the industry in which it is operating, the purpose of valuation. Sometimes I have seen that the valuers are not aware that where their report is being used and they are issuing the report. So all of these things, if you look into that, the registered valuer rules, which got framed in 2017 in India, the registered valuer rules, in fact, have framed a format of the report also. So what should be the valuation report looking like? What are the essential ingredients of the valuation report? Now, things like valuation standards, things like rules and regulations, things like common education, all these things bring trust in the valuation profession. And what we all have been trying to do is that how do we make sure, the next big thing is that how do we make sure that different people come out with common valuation basis. That is something which is the next focus area now, and training sessions are the best for that. So I think that is all from my side. If there is any further question, we can take it up. Otherwise, we can wrap it.
Yes, sir. Thank you so much. Now, we have another question. What could be done if the industry standards are not available? In Nepal, they don't have published industry data in most business sector.
Yeah, so I think we discussed this question, and I'm sure there would be companies and there would be, I mean, when you say that they have not disclosed, I have not done much work in Nepal, so I cannot comment there, but I'm sure that there should be some way of deriving the data, because I mean, I don't agree with this that there would not be industry data available. So there should be some ways and means of getting the data, and maybe by a better due diligence we can get access to that.
How to determine the credibility of outside unpublished, that is not public documents data, and information for comparable measure.
Now, can you just repeat the question?
How to determine the credibility of outside unpublished data and information for comparable measure.
So basically, when we look at the external data, then we look at the reliable agencies. Reliable agencies could be the credit rating agencies, reliable agencies could be the government agencies, reliable. So it's not that, a student has written some document and we are relying on that document. So the idea is to look for credible data, which is the data which is not given to you, but which already exists in public domain. So a few sources of credible data could be the annual reports of the company. It could be the industry reports. It could be the, credit rating reports. It could be some presentations of some industry bodies, or, some recent events and all. So you have to, I mean, what I suggested was that you have to rely on credible data. And if you do not have confidence on the quality of that data, like, you can ignore that, or maybe you have to dig deeper. Like if you like, I just Googled out that what is industry data in Nepal. So there is this company Statistica, which says that statistics about economy and politics in Nepal. Second is data sets, Open Data Nepal. Third is industrial statistics resources. So, I mean, there are a number of data which the moment I have Googled. Now, what happens is that there are different data can give contradictory information also. So we have to make sure that the data comes from reliable sources and the data comes from the organizations which are trusted. So, over a period of time, you can understand that even for credible firms, like in Nepal, there are, larger chartered accountant firms and they are doing research, larger professional firms. So, I mean, any data, any research which is done by credible firm, which has decent experience, those can be considered as reasonable data in my view.
Okay, thank you. Another question, why does the standard not consider internal brands as intangible? Does the company may have specific patents?
So the way the accounting standards are made, they are made on historical cost convention. So historical cost convention is that when you buy something, you account for it. Generally, when you say brands, if you started a company and when the company was started, the brand started with it. So there is no value of the brand. No, when you started when you start something, uh, it just grows over time. So if you acquire a brand, if you acquire a patent, then definitely that amount will be reflected in the balance sheet. But generally, if you look into the Indian accounting standards and even the global accounting standards, then the self-acquired intangibles are not permitted to be capitalized. The self-generated, I'm sorry, the self-generated intangibles are not permitted to be capitalized. Only if you have acquired some intangible, if you actually paid for some intangible, so only that can be capitalized basically.
Thank you. The last one is the valuation report. The valuation report will be valid for what period of time? And if the assumptions used for valuation was wrong, what will happen to the valuation report issue?
So first of all, go back and look into the purpose of valuation. Each purpose is different. Understand whether there are certain regulations around that valuation. Just to give you example, like if you are doing a valuation in India, and let's say you are doing a valuation for RBI purposes. So RBI permit a 3 months period. Again, recently, even SEBI and even income tax I have kind of accepted a 3 months period. Earlier, we used to say that a valuation report could be valid for 6 months period. But ideally speaking, because there is a concept of valuation date and each date is important. So valuation ideally should be done on each specific date. And there is no such concept like for what period it is valid, because if for a company even nothing can happen in 1 year, and for a startup a lot can happen in 1 month. So I mean, let's not be generic, but if you ask that nothing material has happened in my company, I mean 3 months is a reasonable period. After 3 months we should consider a fresh report, not before that. And when it comes to assumptions, again there could be some assumptions taken by the management, and there can be some assumptions taken by the valuer. So which assumptions goes wrong? Because valuation is based on the assumptions and data provided to you. So I mean, if something comes across a valuer which was not told to you, valuer can go forward and revise the report. But if company has taken assumptions and you have done independent assessment, and the idea is to be conscious of the data you are relying upon. The idea is to be knowing that whether this data will be a reasonable data or not. And after doing all this, doing justification, having confidence that yes, the valuation number that I am giving, I will stand by that number. Now if something happens later which was not known to you, again, the concept is known or knowable on the valuation date. If that was knowable on the valuation date, you did not consider, it's your fault. But if that was not something, I mean, you valued something on 31st of March, a fire broke on 30th of April. It's not your problem. No, I have signed a report. It was known and knowable on the valuation date. What happens subsequently is not my problem. But if you are signing, even if you are when you are signing the report and something comes to your knowledge, you can consider whether to incorporate that, whether by way of a disclosure or whether by way of explanation. it is always advisable to disclose as much as possible and make sure that by the time you are signing, you agree with whatever you are mentioning there.
Okay, thank you so much. So it's time to wrap up the first session uh, by giving vote of thanks to the speaker. So I would like to thank you, sir, for the insightful deliberation on the topic. Your expertise has enriched all participants' understanding and knowledge. Grateful for your valuable contribution. And now it's time to move to our next session with our next speaker. So we eagerly welcome CA Rakesh Kumar Tulsianji to delve into option valuation encompassing psych.
Inderjeet,
Yes,
hello.
yes,
Our
yes.
next speaker is Tarun Mahajan, sir. Actually, Rakesh sir is not available today.
Okay.
Mhm.
Just
Do
give
you
me a
have
second.
his profile? If you, let me introduce Mr. Tarun Mahajan. Yeah. Tarun Mahajan, sir, is a chartered accountant, practicing chartered accountant. He's an all India ranker in CA examination. He is also a valuer, registered with IBBI, and doing complex valuation assignment across India. He has been part of the research committee on the valuation set up by the Ministry of Finance, Government of India. He is also a chartered accountant, financial analyst from USA, and certified valuation analyst from CVA from USA. Uh, he is also national level faculty for valuation course and has taught valuation to more than 4,200 practicing CAs, CS, and CMEs. So, for this remark, welcome, sir.
Thank you. Thanks a
Thank
lot for the introduction.
Yeah,
So I will start sharing my screen. Just give me a moment.
yeah, sure, sir.
Okay. So I hope my screen is shared properly
yes, yes, sir.
and my audio and video are also good enough.
Yes, sir. Perfect.
Okay. Fantastic. So as I could understand that this is more going to be a one-way webinar where the participants will keep posting their queries, which we can handle at the end of the session. But I kind of request all the participants that while we are during the session also, you can keep posting your queries in the question and answer box, Q&A box. You can keep posting your queries over there. And I request the moderator that if there are any queries, don't wait for the end of the session. Rather than you can stop me and you can ask those queries on behalf of participants, and I'll be more than happy to answer those queries. Because I usually believe in one-to-one interactive sessions, but this webinar mode doesn't allow me to see the participants. That's why I'm requesting the moderator. All right, guys. So here I go now. We have to discuss valuation of options, and if time permits, 2-3 small topics also. And I believe that time won't permit actually, because valuation of option itself is such a huge thing that even if I keep speaking and you keep practicing it for next 10 hours, still we cannot complete it. It is really something very big. One of the questions may be, as a practitioner, as a valuer, what are the situations when we are required to make valuation of option? And I'll give you some examples for the same. So one such example is valuation of ESOPs, employee stock options. Nowadays, most of the startups, they offer ESOP to their employees because to attract the talent, they are not in a position to pay very high packages in competition with the already established companies. And that's why, how do they attract the employees? They say you will get to learn many things when you work with a startup. And we will also make you partner in our business by giving you ESOP. So ESOP is, with the startup culture, it is very much in practice. So every now and then one has to make valuation of ESOP. So that is based on valuation of options. This is one. Then if there are some complex securities, convertible securities, like the optionally convertible debentures or optionally convertible preference shares are there, in that case also, you'll have to make valuation of options. Or there may be a situation like convertible notes are issued, which are, or safe instruments are issued, or I-safe instruments are issued, which are similar to OCPS, or if a company is issuing warrants, in these cases, you'll have to make valuation of options. Another situation where you will have to make valuation of option is when you are dealing in the futures and options market for the purpose of speculation or for the purpose of hedging or maybe for the purpose of arbitrage. In those cases, you will have to make valuation of options. So this is the requirement where this topic is actually used. Now, what is option? Option is basically a derivative. So there may be a question, what is derivative and what are the types of derivatives? So derivatives may be broadly classified into 4 parts. One is forward contract, then there is future contract, then there is option contract, and then there are swap contracts. There may be other types of derivatives, but these are the 4 major types of derivative contracts. So there is a question, what do you mean by derivative? Derivative is a contract. What is derivative? It's a contract where the value of contract, where the contract does not have its own intrinsic value. Rather than value of contract is dependent on value of some other item. That other item is named as the underlying. So derivative means a contract whose value is derived from the value of underlying or the other item. So forward, future, option, and swap. In Indian market, if I give you example, the forward contracts are usually entered into for foreign exchange risk management purposes. I am an exporter. I'm going to receive US dollars. I have a fear that after 3 months, when I receive dollars, the rate of dollar may fall down against my home currency. So in that case, I book a forward exchange contract. This is an example of derivative forward contract. Then what are futures? So futures are simply exchange regulated forward contracts. If Tarun Mahajan and say Mukesh Gupta enters into a contract, personally, it's a forward contract. But if you are trading through any exchange, maybe a commodity exchange or currency exchange or stock exchange, then that same forward contract is called as future contract. Now the question is, what is option contract? So there is a very important difference between future contract and the option contract. In a future contract, both the parties have right as well as obligation to execute the contract. Now, what does that mean? Suppose you and me enter into a contract whereby I agree to buy gold from you, 1 kilogram of gold from you, say at 60 lakh Indian rupees, and you agree to sell 1 kilogram of gold at 60 lakh Indian rupees. Then after 3 months, not today, but the price is agreed today. Now, after 3 months, whether the price goes up or comes down, both of us have obligation to execute this contract. Both of us have right to execute this contract. So if both the parties have right as well as duty to execute a contract, it is basically a future contract. That is, you will deal in future, but you are deciding, you're fixing the rate today. Now, what is option contract? Let me give you a warning once again that option is a very complex contract. And making valuation of option is something you can discuss for many hours, 10, 20, 30 hours minimum. So summarizing it in 1.5 hours is like some of the things will be delivered and some of the things will remain a food for thought. Okay, so that's why I'm saying feel free to ask your doubts, and as soon as any doubt is shooted, the moderators are kind enough that they will pass it on to me. Okay, guys, so options are of two types. One is call option, and another one is put option. Call option simply means, suppose I have a call option, it means I have the right to buy. When I have a right to buy, it is named as call option. And when I have a right to sell, it is named as a put option. I'm assuming that you have the basic knowledge of derivatives. I'm just giving you a quick revision of the same. And once we have the quick revision of what is derivative, then we will jump into how to make valuation. Call option, right to buy on a specified future date at a predetermined rate. That predetermined rate is named as the strike price. Suppose you give me, Tarun Mahajan, right to buy 1,000 shares of Reliance Industries Limited. Okay, an Indian stock. Let me check what is RIL share price today. It was roughly 2,400 rupees. So today you give me right to buy 1,000 shares of Reliance Industries Limited after 3 months at a strike price of 2,400. Currently, the share is trading at 2,437. You have given me a right to buy this share after 3 months at 2,400 Indian rupees. Now, this is a call option. And I am the call holder and you are the call writer. On the other hand, what is put option? Suppose you give me an option to sell 1,000 equity shares of Reliance Industries Limited after 3 months at 2,400. Now I have right to sell. This is the put option. I am put holder and you are put writer. Okay. Now, so there are two parties, whether we have a call contract or we have a put contract. In both cases, there are two parties. One is the holder, another one is the writer. One who holds the option, who has the choice to exercise, is called the option holder, or you can say he is long the option. And to acquire this option, he has to pay premium at the inception of the contract. And one who has given this option, like you have given me the option, then you are the option writer. So I can say I'm long the option, I'm option holder. My counterparty, you are option writer. That is, you have created a short position in the option and you receive the premium. See, what is the difference between option and future? In future, I have right as well as duty to buy RIL share at 2,400. But in option, I have a choice to buy at 2,400. After 3 months, if the market price appears to be 2,700 rupees, I will happily exercise my option to buy at 2,400 rupees and make a profit of 300 rupees. You know how? I have right to buy something for 2,400, which has a fair price at that time of 2,700. So I will happily exercise my option. On the other hand, after 3 months, if the share price comes down to 2,100, I'll not exercise my option. Something which is available in the market at 2,100, why should I buy it at 2,400? Then I will say, let's expire this option worthless. So buying an option is like buying an insurance policy. If there is a damage, if there is an opportunity to claim something, then you will make a claim. If there is no damage, in fact, there is a profit, you will not make any insurance claim. So buying an option is like buying an insurance contract. One who buys the insurance contract will have to pay the premium, and one who is selling the insurance contract will receive the premium. So one who buys the option holder pays the premium, and one who sells the option writer, he receives the premium. I pay, you receive. Now the beautiful thing is that the option holder's loss is limited up to the amount of premium only. If I have paid you premium of 100 rupees per share for Reliance Industries Limited share to be bought after 3 months at 2400, my maximum loss is limited to the premium 100 rupees. Because if the price becomes unfavorable, I won't exercise the option, and at the most my premium is lost, full stop. But my gain is unlimited. If the RIL share price shoots up, say to 5,000 rupees, imaginarily in 3 months' time, then I'll make huge profit out of it. My upside is unlimited, my downside is limited up to the amount of premium. Option writer has just a reverse position. His upside is limited to the amount of premium he received. At the most, option will not be exercised and premium will become his income. But his downside, that is loss, is unlimited. Whether it is call option or it is put option, in both cases, these two lines are true. Let's take a quick example of call option. See, I wish either you guys also open Microsoft Excel and keep doing the calculations, whatever I do, whatever you see on the screen. You can partition your screen in 2 parts. And in one part, you see my calculation, and in another part of your screen, you do your calculations yourself. That will be fantastic. That is the best way to learn. Otherwise, at least you have the copy and pen ready and keep noting the concepts I'm saying. Later, I will share this file with you, don't worry. But if you note it in your own language, that will be the best. Okay, let's take an example. Suppose current market price of share of ABC Limited is rupees 2600. And I take a call option that I will buy it at 2500 after 3 months. And suppose call premium is, say, 120 rupees, let's say. By paying a premium of 120 rupees, I am buying the right to buy this share after 3 months at 2500, even if the price is above 2500. Now, what is my payoff being the option holder? I'll tell you. So, what can be the share price after 3 months? It can be anything. It can be between 0 and infinite, theoretically. So, the price can take n number of values after 3 months. So, I have taken some random prices. The price may drop down from 2600 to 2000, or it may rise to 2700, or it may rise to 3000, or it may rise to 4000. Now, I am the call option holder. I have right to buy at 2500 rupees. So when I have right to buy at 2500 rupees and the market price is just 2000, what do you think? Should I exercise my option to buy at 2500? No, definitely not. I'll say it is available in the market at 2000. Why should I buy it from you at 2500? I won't exercise my option, and my option will expire worthless at 0 price. Though I have paid a premium of 120 rupees at the beginning of this contract, hence my net result is 120 rupees negative. That's my loss. Even if the price becomes 0, my maximum loss is limited to 120 rupees, the amount of premium I have paid. If the price becomes 2700 rupees, what do you think? Should I exercise this option to buy at 2500? The answer is yes. I must buy it. I must exercise the option because something worth 2700 in the market, I have the right to buy at 2500. This is how. So actually, I don't have to give you. There are two ways to settle option contract. I give you 2500 rupees cash. You deliver me the share. Immediately, I'll go to the market and sell this share and bring in 2700 rupees and make a net profit of 200 rupees. So this is called delivery settlement of the option. Alternatively, we can have cash settlement of the option, where if the price goes up to 2700, I say, look, in this bet, I win, you lose. So you simply give me 200 rupees and let's not make delivery settlement because I don't have 2500 rupees cash to pay to you. And maybe you don't have delivery of the share to give it to me. So better you give me 200 rupees and the contract will be settled. But this is today. 3 months ago, I have already paid you 120 rupees premium. So my net result is 80. If you ask me what is the value of my option after 3 months, so here value of my option after 3 months is 200. Here value of my option after 3 months is 0. If the price becomes 3000, I make 500 rupees profit. If the price becomes 4000, I'll make a profit of 1500 rupees. You know how 1500 rupees? Because I have a right to buy at 2500 and the price is 4000. So I'll exercise my option and 1500 rupees I will recover from you. In any case, whether I exercise the option or I don't exercise the option, I have already paid a premium of 120 rupees, which is irrecoverable. So here my net result is like 380 rupees. And here my net result is like 1380 rupees. So now you look at it. My maximum loss is limited to 120 rupees, even if the price of the share becomes 0. But there is no limit on my maximum amount of profit. It can be theoretically infinite rupees. So this is the situation of a holder of a call option. If you talk about the writer of a call option, the cash flows, the signs will be simply reversed. You know, for a writer, what will happen? This will be plus 120 because he is receiving the premium. And this will be minus 200 because he'll have to pay the difference, minus 500, minus 1500. So for the writer of option, situation is just reversed. Cash flows are exactly same, just the sign is reversed. So his maximum profit is limited to the amount of premium, while his maximum loss is theoretically unlimited, infinite rupees it can. So if you look at the payoff of holder and writer, they are just the mirror image of each other. Whatever holder receives is paid by the writer, and whatever holder pays is received by the writer. That's why it is said that derivative is a zero-sum game. At the end of the day, if for the entire market you make a sum total of profit and loss, it will be 0. Nothing is created, nothing is destroyed under derivatives. Only the money changes hands. Now, if I talk about the payoff table of put holder, suppose same situation we take. Current market price of the share is 2600. Strike price is 2500. But this time, I want to sell the share at 2500 after 3 months. And for this, I have to pay you a premium of 50 rupees. I have right to sell at 2,500 after 3 months. See, if you have any of the doubts, don't restrict your doubts. Don't judge yourself whether it is a silly doubt or difficult doubt or relevant doubt or irrelevant doubt. You just shoot your doubt. I will decide what to answer, right? So you don't filter at your level. Shoot every question you have in your mind. Now again, price after 3 months can take any value. It can be 1,000, 2,000, 2,400, 5,000, anything. It can be anything. So I have taken some simple prices. Now, if the price of the share drops down to 1,000 rupees and I have right to sell it 2,500 rupees, I'll be really happy and I'll exercise the option that the share is worth rupees 1,000 in the market and I have a right to sell at 2,500. So I will definitely exercise this right and make a profit of 1,500 rupees. Here it is 2,000. I have right to sell it 2,500. So I make a profit of 500. Here also I make a profit of 50. Because something worth 2,450, I can sell for 2,500. Here I don't make any profit because share is worth 5,000. Why should I sell it at 2,500? I won't exercise the option. In any case, I have paid a premium of 50 rupees. So my net result looks like this. See, being the put option holder, again, my maximum loss is limited up to the amount of premium, while my maximum profit can be huge, right? And the writer will have the opposite position. His maximum profit will be capped up to the amount of premium received, while loss can be anything. Now, look at this. That if you ask me what is the value of put option at expiry, I will say if price becomes 1,000, the value of put option is 1,500. So whenever there is a negative value of the option, we don't exercise the option, and that's why the option value becomes 0. Whenever there is a positive value of the option, we exercise the option and recover that value. So this positive, whenever the option has positive value, we show it as positive. When it is 0, we show it as 0. When it is negative, we don't exercise the option. So that also becomes 0. Now the question is, how do you make valuation of option? So there are two popular models. One is the Black and Scholes option pricing model. If you look at this model, you may be scared of it. That, oh my God, so much deep mathematical calculations are involved. That is the fact. That is the matter of fact. The good thing is that there are, many ready-made option pricing sites which are available, like option price calculator. Just a minute. option-price.com. That is the website. option-price.com. So if you want to make valuation of option using the Black and Scholes option pricing model, this is the site you can use directly. Let me tell you one thing, that why do you want to make valuation of option? Because how do you decide then that what premium are you ready to pay? So here in the example, I said that 120 rupees is the premium. or I said that 50 rupees is the premium. So we simply solved the question using this premium. But who will decide that what should be the premium? Maybe the holder will try to pay minimum premium and writer will try to ask maximum premium. So how do they agree at one option premium? And that is what we are trying to calculate. When I say I am making valuation of option, it means I am trying to figure out what is the fair value of this premium. That is what it is. So look at this. Let's take an example. In this example itself, suppose 2600 is the price of the share and you want to buy it for 2500 rupees. Without solving this example, I can tell you one thing, that the premium must be at least 100 rupees, because this is the intrinsic value of the option. Something worth rupees 2600 today, you want to buy for 2500 after 3 months. That means 100 rupees profit you are asking immediately. So premium will be at least 100 rupees. 3 months, let's say 91 days are there. Interest rate. Here you must always put the risk-free interest rate of the country where you are making valuation of this option, right? So for a 3 months time period, suppose risk-free rate of interest in India is 5% per annum. So I write here 5%. Dividend yield, that means how much dividend is expected to be paid in this 91 days time. And we are sitting in the month of December. So in January, February, March, company is not expected to pay any dividend. Otherwise, also this company is non-dividend paying company. So I put dividend yield equal to 0%. Now, this is one important input. What is the volatility of your share? It means how much the return on this share fluctuates. So suppose the volatility is 25% per annum. So ideally, 1,000 rupees share should increase by 25% or reduce by 25% in 1 year time period. That is 1,000 rupees share should remain between 750 and 1250 within 1 year time period, most probably. That is volatility. So how do you calculate this volatility? It is simply the standard deviation of the shares return. Okay. Then I simply now I have given 5 inputs. Current price, the strike price I have chosen. This is the price I don't choose. For the listed stock, it is there quoted. This is the price I choose. Period I choose. Rate of interest, risk-free rate of interest. That is the government security rate of interest. Should be put here. I don't choose it. Volatility, I don't choose it. I must calculate and put it here. And then I say calculate. And here I go. Look at this. The call option premium ideally, in this case, should be 202 rupees. And the put option premium in this case should be 71 rupees only. I'll tell you why is it so. Now, these are called option Greeks. Delta, gamma, vega, theta, rho. This is deep mathematics. Let's avoid it as of now. But you should notice one thing, that call option is worth 202 and put option is worth 71 rupees if you choose a strike price of 2500. You know, because the call option is having a favorable strike price. A share worth rupees 2600 today, you want to buy for 2500. 100 rupees favor you are asking, that's why the call option premium is higher. On the other hand, a share worth rupees 2600 today, you want to sell it for 2500. So that is unfavorable because you are selling cheaper than the current market price. And that's why the premium is less. if I do the reverse thing, if I put here 2700 and I say calculate, now the premium is reversed. See, now the put option premium is higher because put option is having a favorable strike price. You are selling at a higher price. And call option premium is lower because here the price is unfavorable. Share worth rupees 2600. You are ready to buy at 2700. That's why the call premium is less. So you must be thinking that how this is being calculated. And my dear friends and respected senior colleagues, these are the steps for calculation. Being a valuer, you can use this option calculator, but it is advisable that don't use that ready-made option calculator or online one. Use the formula. You have to calculate D1, you have to calculate D2, then you will have to calculate ND1, then you will have to calculate ND2, and then you put the value of ND1, ND2, share price, strike price, risk-free rate of interest, time to expiry in this formula, and you can calculate value of call option. Similarly, you can calculate value of put option. So this is not really very difficult. You know, if I tell you how to put these numbers, like here we did it 2500, no? 2500. And suppose I say, okay, 91 days. This is 202. We can also calculate it on Excel. I can just show you quickly. Let's not make the whole calculation, but at least I'll tell you how to put figures in this formula. Just a minute. Okay, so this is natural log. Value of the stock. Value of the stock is 2600. Strike price you have chosen is 2500. Risk-free rate of interest is 0.05. Volatility is like 0.25, 25%. And T is the time period in terms of number of years. So 3 months is like 0.25 years. Similarly, 3 months is like 0.25 years. Now, coincidentally, the sigma and T have become same. This is the volatility, 25%, and this is the time period. So now you can figure out what is D1, and Excel offers all these calculations. And then you can calculate D2, ND1, and ND2. Let me just do one thing for you. I'll create one option calculator here in Excel, and later this file will be shared with you. So you can have your own option calculator. Let me just do it for you. VS E R T sigma. That is standard deviation. This was 2600. This is 2500 rupees. This is 5%. This is 0.25 years. This must be per annum. This must be number of years. And let's say this is 30%. Let's do one thing. Because, 25 and 25, two things together will create a confusion. Let's put it equal to 30%. And this to be 92 days. So when we calculate in Excel, the answer should come at 226. Let's see. First, let's calculate D1. How do you calculate D1? So for that, you'll have to take natural log. So in Excel, there is a formula for natural log, ln of VS divided by E. And then plus, you have to do what? R plus half of sigma square. So this is your R plus half, that is 0.5, into sigma square. Sigma raised to the power, shift 6 gives you this symbol, square, multiplied by T. This is the T. So this is the numerator part of the formula, divided by sigma under root T. This is sigma multiplied by T raised to the power 0.5. This is how you make under root. This is the denominator part of the formula. So this divided by this gives you D1. Don't worry, I'll share this Excel file with you. Then how do you calculate D2? So there is a shortcut to calculate D2, and that shortcut is you take D1 and deduct sigma under root T. This is D2. Then you have to calculate ND1. What is ND1? Now that's a question. This is we are trying to calculate probability. This is deep into the statistics, that you are using the standard normal probability distribution table over here and trying to figure out ND1 and ND2. So ND1 is the Z table value, or we are trying to figure out the probability. So there is a function in Excel which is, you'll have to calculate norm.s.dist. This is normal standard distribution. So this is the Z value, that is D1. And do you want to calculate cumulative? I'll say true. Yeah, I want to calculate cumulative. And this is my MD2. I know this is very mathematical, but this is how it is. So how do I calculate this ND1 thing? I just calculate the normal distribution value of my D1. This is D1. And finally, the value of call option. So here we have the formula. For call option, first you have to take value of the stock and then multiplied by ND1, which is 0.66. And then you deduct strike price and multiply this strike price by ND2, which is this one. And this thing, whole thing, is divided by the future value factor. This is future value factor. So for this, we have, EXP function in Excel. EXP of what? R into T. This is R. This is multiplied by T. And see, 226 rupees. And this ready-made calculator was also giving us this little difference is there because I have taken 92 days. And here I have taken 0.25 years. That's why this slight difference is there. This is how you calculate value of call option. So formula I have given, and then how to put the figure I am telling you. Now, how to calculate value of put option. Very similar steps are there. So first, here you take the exercise price. But now you don't have to, you have to put here N minus D1 and N minus D2. So first, let's calculate that part. If you are thinking that what is the logic behind all these steps, then let me tell you that this is the formula derived using differential and integral calculus, which is deep into mathematics. None of our business. We just learn to use this formula. Just give me a moment, please. So how do I calculate this? See, here, if I put a minus sign, I got it. And here also same. If I put a minus sign, I got it and minus D2. Now, value of the put option. How do I calculate it? I take the strike price. What is strike price? The price I choose to buy or to sell. Multiplied by N minus D2. Divided by exponential of R into T. 5% into 0.25. Minus value of the stock 2600 multiplied by N minus D1. So 94 rupees is the value of put option. See, 95. So that's a ready proof that whatever we have calculated is correct. Now this is your own option calculator in your own Excel file. Advantage of having it in your own Excel file is that you can integrate it with your rest of the financial model. Otherwise, integrating it with that website is like nearly not possible. But now you are not dependent on any website. You have your own option calculator, and I'll share it with you. Don't worry about it. The black and shoes option pricing model is something which we can't try to derive that how the formula is derived. We can just try to use it. Okay. But on the other hand, there is one more model which is called binomial pricing model. Before going to that model, let me tell you that options are of two types. Number one is European option. And number two is American option. What is European option? It can be exercised only at the expiry date. And what is American option? It can be exercised on any day till the expiry date. So if I am taking a 3 months European option, I'll have to wait till the end of 3 months. Suppose if at the end of 2 months, price rises crazily, and I'm sure that this level of price will not be maintained up to the end of 3rd month. So I wish that I could exercise this option here itself at the end of 2nd month rather than up to the end of 3rd month. European option doesn't give me that facility. European option can be exercised only at expiry, not before that. But if I have an American option, then I'll have the choice either to, I'll have the choice to exercise it now, or maybe exercise it after 1 day, 1 week, 1 month, 2 months, 3 months, like this. This is American option. So European option can be valued using the Black and Scholes option pricing model. But American option cannot be valued using the Black and Scholes option pricing model. To make valuation of American options, you must use binomial pricing model. For European option, you have choice either to use the Black and Scholes option pricing model or to use the binomial pricing model. But for American option, you don't have a choice. You can only use binomial pricing model. So binomial pricing model also becomes very important. Now let's see how to make valuation using the binomial pricing model. Now this method is sheer logic. It's pure logic. So here I request everyone to pay attention, to remain attentive, and we will go very, we'll go very systematically, step by step. You will be able to grasp every single step. You just need to remain attentive. So the binomial pricing model, which is also named as the risk neutral method, and which is also named as the lattice model. The basic assumption of binomial pricing model is that the share price can take only two possible values till the expiry date of the option. That's why 2 is buy. That's why binomial pricing model. A share is worth rupees 5,000 today. In 3 months' time, either it will rise to say 6,000 or fall to say 4,000. So there are only two probable prices, either 6,000 or 4,000. That's why this model is named as the binomial pricing model. So let's take an example. Current market price of ABC Limited is 1,000 rupees. The symbol here is VS, stands for value of the stock. Today's price is 1,000 rupees. Now strike price I choose is 950 rupees. What does that mean? I have chosen a favorable strike price. Option premium will be at least 50 rupees. I have chosen a favorable strike price. Now, if I choose a favorable strike price, definitely I will have to pay comparatively higher premium. Okay. Now, suppose the option will expire in 6 months. So being the call option holder, I have right to buy this share at rupees 950 after 6 months. Now the question says that in 6 months' time, either the share will go up by 10% or will come down by 20%. There are two possibilities only. So VS, value of stock, is 1,000, but upside value of stock is 1,100. That is 1,000 plus 10%. Right? And downside value of stock is 1,000 minus 20%, which is actually 800 rupees. I can also say that the upside factor is 1.1. Let me write it like this. Upside factor is 1.10. So 1,000 multiplied by 1.10 gives me 1,100. This is like 1,000. 1.10 is upside factor multiplied by 1,000 is 1,100. And downside value of stock, so downside factor is 0.80 multiplied by 1,000 gives me 800. So I'll say the downside factor is 0.80. How come this factor? 10% appreciation, 20% depreciation. Now, allow me to create one binomial tree, price tree. The share is worth ₹1,000 today. Either it will rise to 1100 or it will fall to 800. Okay. Either it will rise to 1100 or it will fall to 800. If the price falls down to 800, I have right to buy at 950 and the market price is just 800. So the thing is, I will not exercise this option. You know why I will not exercise the option? Because I have right to buy at 950 and the price has came down to 800 level. That means I won't exercise the option. Why should I buy at 950 when the price is 800 only in the market? So I'll say the downside value of my call option, is 0, DVC. But if the price rises to 1100 and I have right to buy at 950, I will definitely exercise this option. And I will buy at 950 because the price is 1100. And this way I have made a profit of 150. So I will say that upside value of my call option is 150 UVC, upside value of call option. See, I want to calculate value of option today, and now I already know the value of option after 6 months. I want to calculate fair value of option today. I already know the fair value of option after 6 months. So, and not one value. In fact, I know two different values. So now the simple logic is I'll take an average of 150 and 0 because I'm not sure whether 150 will happen or 0 will happen. So I'll take an average of 150 and 0, and whatever average is calculated, then I will calculate present value of that average. That will become the current fair value of the option. That's all. That's the simple logic of binomial pricing model. But Black-Scholes doesn't offer you any logic. It simply gives you a formula. Binomial is very systematic and logical. So I have to first calculate an average of 150 and 0, and then calculate present value of that average. So the question is, should I calculate a simple average or weighted average? And the answer is, you should calculate weighted average. You should assign a weight of 5/6 to this upside branch and 1/6 to this downside branch. We call it P and 1 minus P. P is 5/6, 1 minus P is 1/6. You must be thinking that how come this 5/6 and 1/6? I'll tell you later how to calculate this 5/6 and 1/6. Currently, you just try to calculate an average of 150 and 0 using a weightage of 5/6 and 1/6. That is, you have to do 150 into 5/6 plus 0 into 1/6. 0 into anything is actually 0. And 150 into 5 is 750. 750 by 6 is actually 125. So the weighted average option fair value, weighted average options fair value after 6 months is 125. Now you already know the value of option, fair value of option after 6 months. You just have to calculate the current fair value. So how to calculate current fair value? Just calculate the present value of this future 125 rupees. You see, this is the formula for present value. Present value is equal to future value divided by 1 plus Rn. If you are using simple interest, it is 1 plus Rn. If you are using a compound interest, it will be 1 plus R raised to the power n. Let's keep things simple. So we are using the simple interest. 125 rupees is the future value of option, divided by R is 5%. I'm sorry, I forgot to mention that the risk-free rate of interest is 10% and number of years are 0.5 because 6 months is actually 0.5. 6 months is actually 0.5, right? So this is 10% into 0.5, which is 5%. So it is simply 10% for the whole year. That's why 5% is for the half year. And that's why this 1 plus 5% is 1.05. This is the final answer. Current fair value of this option is 119.05. As we are not having interaction, I'm sure some of you must have been left behind or having some confusion in this entire example. So I'll simply repeat it for you. A share is worth rupees 1000 today. You can give cash of 1000 rupees and buy this share. But you say, no, I will buy this share after 6 months at a price of 950 rupees. Currently, the risk-free rate of interest is 10% per annum. So you have taken a favorable strike price, favor of 50 rupees. Now, in 6 months' time, you estimate that this 1000 rupees share will not stay at 1000. Either it will go up or it will come down. If it goes up, it will go up by 10%. So 1000 rupees will become 1100. If it comes down, it will come down by 20%. So 1000 rupees share will become 800. So either the price will be 1100 or it will be 800. So upside factor is like 10% up, 1.10. Downside factor is like 20% down. So it is 0.80. So now we created this 3000 rupees share can go up to 1100. In that case, value of option will be 150. How come 150? The share price then will be 1100. You have right to buy it only 950. That's your gain of 150 rupees. If the share price then becomes 800, you have right to buy it 950. You won't exercise the option. It will expire worthless. So value of option is 0. Now you know value of option after 6 months. You just have to take an average because you don't know single value. You know two different values. So give a weightage of 5/6 and 1/6 and calculate an average of 150 and 0, which is actually 125. Once you calculate this average, this is the fair value of option after 6 months. But I am interested in knowing fair value of option today. So I'll calculate present value of 125 with 10% interest rate. 10% is for the whole year. So I'll have to make it half for the half year, which is 5%. And that's why I'm dividing it by 1.05. So the present value becomes 119.05. That's the final answer. Okay. Now one question remains. How come this 5/6 and 1/6? So now there is math behind it. There is a formula to calculate this P. I'll give you one simple way to memorize this formula for P. P, which is 5/6, right? How to calculate it? The formula to calculate P is U minus D upon U minus D. U is the upside factor, D is the downside factor. But if I do U minus D upon U minus D, it will become 1. So this numerator U, I will replace by 1 plus Rn. This same thing, 1 plus Rn here. This is not the logic, my dear friends. This is the way to memorize it. Now 1 plus Rn here is 1.05. D is 0.80. U is 1.10. Let's put here all values. 1 plus Rn is 1.05. D is 0.80. U is 1.10. D is 0.80. So this is 0.25 divided by 0.30. That is 25 by 30. So either I can write it as 5 by 6 or I can also say it is 0.83333. Either way, it is same. How do I calculate 1 minus P? It is simply 1 minus 5 by 6. So 1 minus 5 by 6 will give me 1 by 6. So usually, people think that binomial pricing model is very difficult, but no, it is very logical, not very difficult. Though we have calculated this final answer, but now we can, analyze this answer. See, you have taken a favorable price by 50 rupees. So I said the value of option must be at least 50 rupees. This 50 rupees is called intrinsic value of the option. What do you call it, sir, madam? This is intrinsic value of the option. So the fair value of option is intrinsic value of option plus time value. Fair value of option is 119. And see, the intrinsic value is 50 because you have chosen 50 rupees favorable price. If you choose the strike price to be 1000 instead of 50, this intrinsic value will become 0 because 1000 strike price, 1000 market price. If you choose strike price to be unfavorable, say 1100, so 1000 current market price and 1100 is the price, strike price, the price at which you want to buy. So I won't say intrinsic value is minus 100. If intrinsic value is negative, we treat it to be 0. How do I calculate time value? It is just a balancing figure. So to acquire this option, you will have to pay 119 rupees of premium, out of which 50 rupees is intrinsic value of the option and 69 is time value. Time value is there because the stock is volatile, because the interest factor is there. In this time, stock may go up, come down. And in this time, the interest thing is there. That's why this time value of option is there. I hope this calculation is clear to everyone. Now, you may be thinking that this is an impractical way of doing things, because how can you assume that share can take only 2 probable prices? Share can take actually n number of probable prices. So just give me a moment. Share can take n number of probable prices, and that's true. And this model is capable of considering those n number of prices also. You know how? The share is worth, the share is worth rupees 1000 today. It can go up by 10%, come down by 10%, and again it can go up by 10%, come down by 10%, go up by 10%, come down by 10%, and again it can go up, come down, go up, come down, go up, come down. So if I make one time step of 6 months, or I can make 2 steps of 3 months each, or I can draw 3 steps of 1 month each, or I can draw 181 steps of 1 day each. As I make more and more steps, I'll be able to consider more and more probable prices. Look here, I'm able to consider only 2 probable prices. But if I make a 2-step tree, I can consider 3 probable prices. If I make 3-step tree, I can consider 1, 2, 3, 4 probable prices. If I make n steps, I'll be able to consider n plus 1 probable prices. So we will just have to learn to extend this binomial tree. Don't say that this is 0, this is 6 months. Say this is 1 day, 2 day, 3 day, 4 day, 5 day, 181 days, 182 days. That way, you will be able to consider many prices practically. So I will demonstrate you a 2-step binomial tree. Yeah, you already tried. A 2-step binomial tree. Current market price of share is 1000. Stock price is 950. Risk-free rate is 10%. Number of years are 0.5. That is, it is 6 months option. Exactly same as the previous example. But here I won't take 1 time step of 6 months. I'll take 2 time steps of 3 months. In 3 months time, either it will go up by 10%, come down by 10%, little change in volatility also. So 10% up, down, again 10% up, down, 2 times. What is value of 6 months call option? So look, first of all, 1000 rupees share, either it will go up to 1100 rupees, that is 10% up, or come down by 10% to 900 rupees. Then this 1100 rupees share can again go up, come down, and then 900 rupees price can again go up, come down. 1100 plus 10% is 1210. 1100 minus 10% is 990. 900 plus 10% is 990. 900 minus 10% is 810. Let's assume it's a European option. So being the European option, you can exercise only after 6 months. If the price is 810, I won't exercise the option. It will become 0. You know, strike price is 950. Right to buy at 950. Price in the market is 810. Why should I buy it at 950? I won't exercise the option and my value will remain 0. But if it becomes 990, I will exercise the option and I earn 40 rupees. Don't get confused. Figures in bracket does not represent negative number. Figures in bracket simply represent value of the option. If the price becomes 1210, I have right to buy at 950. So 210, 50, 260 rupees I earn. So now I know that value of my option after 6 months will be either 260 or 40 or 0. So now it has become a 2-step binomial tree. What is this? It is a 2-step binomial tree. And how do I solve this binomial tree? In 3 parts. So there are 3 trees. Tree number 1 I will have to solve. Tree number 2 I will solve. Tree number 3 I will solve. And I'll do the reverse calculation. This is called a roll back technique. That is, first I will solve tree number 3. And then I will solve tree number 2. And then I will solve tree number 1. For that, first I'll have to figure out P and 1 minus P. You already know the formula for P and 1 minus P. So P is 1 plus R. So 1 plus R is 1.025. You know why? Because now you have a time step of 3 months. 3 months is like 0.25 years. 10%, 0.25 years is 2.5%. That's why 1.025. Downside factor is 0.90. Upside factor is 1.10. When you will solve it, you will get it equal to 0.625. I repeat, 10% is the rate and 3 months is the time step. So 0.25 years. For 0.25 years, the risk-free rate of interest. Always take risk-free rate of interest in option pricing model. So risk-free rate of interest is 10% into 0.25. That will give you 2.5%. That's why this is 1.025 and downside factor is 0.90. Upside factor is 1.10. When you solve it, you'll get it equal to 0.625. 1 minus P when you do, you'll get 0.375. So if I solve node number 3, I'll calculate an average of 260 and 40 by giving a weight of 0.625 and 0.375. So node number 3, 260 into 0.625 plus 40 into 0.375. And this is the average. This is the average of 260 and 40, right? Once I calculate the average, the next thing I do is to calculate the present value. So to calculate the present value, I will divide by 1.025. I don't know whether you have this mathematic background or not for calculation of present value and all those things. So I'm really sorry if you don't have this background, because here I don't have a choice. I have to assume that you know this calculation. If you don't know any of the calculation, see, you have two options to ask any of the doubts. You can ask me doubts right now, or you can note down my number and you can later WhatsApp your doubts to me. +91, obviously you will have to put here. You can, if you don't get an opportunity to ask here, feel free to ask later. This is my number and this is my email ID. It will be available in the Excel file also later. So you can ask me doubt over here. Better to ask it now. Later, if you wish to ask related to option or anything related to valuation, you can ask me. Don't hesitate to ask any doubts ever related to valuation. Okay, guys. So you calculate an average of these two numbers and then you calculate present value of the same. And this is 173.17. When you calculate an average of 260 and 40, so that 260 and 40 average will be 177.5. And present value of 177.5 will be 173.17. So this value of this node number 3 is actually 173.17. Here, don't see that this is 3. See this as 173.17. Then do the similar calculation at node 2. Calculate an average of 40 and 0 by giving a weight of 0.625 and 0.375. And then calculate its present value. And this will be 24 rupees. So this number 2 is nothing but 24 rupees. Then the next thing is to solve at node number 1. So what do you roll back? You will roll back these two values, 173.17 and 24.39. So 173.17 should be given a weight of, here this is 173.17, should be given a weight of 0.625, this one. And then this is 24.39. This should be given a weight of 0.375. And then calculate the present value. And here you get the value of option 114.51. Just like we have drawn a 2-step tree, you can make a 1,000-step tree, and then you can solve it. You can create one Excel model, and then you can make it permanent. Just change 4 or 5 numbers and your model is ready. It will be able to give you calculations. So this is how we make valuation using the binomial pricing model. We are approaching towards the end of the session, and we have reasonably covered what is derivative, what are options, how to use the Black-Scholes option pricing model, how to use the binomial option pricing model, and we have created one model also, calculator also, using the binomial pricing model, and when to use these models. So I request now participants to ask if there are any doubts. It may, if it is related to option valuation, fantastic. In general, related to valuation, if you have any doubts, you can ask that also. Yes, ma'am. Are there any doubts?
So still, we don't have received any questions regarding to valuation of options right now.
Okay. Okay. So then I can discuss for 5-7 more minutes if there are no doubts.
Yes, sir.
Okay. Okay. I guess this topic is actually, a little difficult. So maybe people are still trying to comprehend it. And once they are done with comprehending it, definitely they will have doubts. And then my number is there in Excel file.
Yes.
Okay. So guys, like how to use, this was European option. This was the European option. But what if it is an American option? Being a European option, you can exercise it here only at the end of 6 months. But for the American option, you can exercise it anywhere. Say here at the end of 3 months also, you can exercise the option. So suppose you exercise the option here at node 3. So what will happen? The price is 1100. You have right to buy it 950. That means 150 rupees you can earn. So at node 3, if you exercise the option, you can immediately get 150 rupees. But if you don't exercise the option, then the present value of future benefits is 173 rupees. So in this case, you will choose not to exercise the option. That's why we won't roll back 150, we will roll back 173.17. Similarly, at node number 2, here, if you exercise the option, you'll get 0 because you have right to buy at 950 and the price is 900. So if you exercise it, you'll get 0. But if you don't exercise it, present value of future benefits will be 24.39. So you should choose to not to exercise it. Now you will roll back 173 and 24.39, just like you did here, 173 and 24.39. When you roll back it here, this will be 114.51. Exactly same as the European option. Now, luckily in this example, coincidentally, the values are coming same. But suppose instead of 150 rupees here, what if it is 200? If it is 200, then I'll say I won't like to continue. Rather, I will like to exercise this option. Then I won't roll back 173 and 24. I will roll back 224. It is like that. So at every node, you can check whether to exercise or not to exercise the option. That is for American option, which is the true application of the binomial pricing model. So that's it from my side. Excel file will be shared with you by the Valuation Standard Board.
Okay, so thank you so much, sir, CA Tarun Mahajan ji, for an insightful discourse on option valuation. And your expertise really enriched our participants' understanding on the topic. So, and I would like to give special thanks to the Valuation Standard Board for organizing these enlightening sessions, and appreciation to the participants for their active engagements. So, let's carry forward the spirit of knowledge sharing. Uh, we will looking forward to more enlightening sessions in the upcoming days. So, thank you all for making day two a resounding success. Thank you, everyone, and have a
Thanks.
good night. Thank you, sir.
Hello, Akash. Hello.